नहीं एकदम से स्क्रीन गायब हो गई थी वापस आ गई ठीक
Thanks for joining in. Give me another 2
थैंक
minutes.
यू
Start. Just giving people enough time to join in. The PIDE webinar. Few housekeeping rules first. Please mute your mics. Let the speaker speak, whoever it is. You can unmute your mic whenever you're ready to speak. But the convention here is we let the speaker speak first. Let them answer their question. And of course, everybody will have a chance to speak. I mean, we never let anybody not have a chance to speak. But obviously, this is a more informed debate that happens on TV. So we are not out to score points. We are just mainly trying to learn. This cartoon that I put up on every webinar, we have a lot of webinars, I'll talk about them, is to just be aware that we are the guy in front of the cart chasing the loan. And that's something that's very important to bear in mind. That's all we've done in our lifetimes, folks, and we're not young people. So the purpose of this is to debate and to enlighten the academic community. I think the business sector is too far from the academic community, and the research that I see being done in the academic community is very divorced from the business sector. So I thought it would be very good for these people to hear you, because it's very difficult for these guys to really talk to you. You guys talk in a VIP circle, and these guys are sitting down there in some other circle. So we're trying to get lots of you people together, and for our academics and our researchers to hear this, and we should go into looking and researching into these subjects, which are of crucial importance to the country. I did a book on academic research recently, and I was very, very disappointed to see the kind of research that is being conducted in the city. And I think leaders like you should take note of that and see how we can improve our research. So this is an effort in that direction. That's why I've bothered you on a Saturday morning. And I'm very grateful to my speakers for giving me the time on this Saturday when they could be enjoying their holiday. We've got a great panel to discuss banking. Banking is a critical issue, and we should discuss it. Every civilized country needs a very good banking setup. We have Atif Bajwa, President and CEO of Bank Al-Falah. We have Zubair Sumro, Chairman of National Bank. All of these people have played critical roles in our banking system. So many of them are so well known, I don't even need to introduce them. Zubair has been in National Bank before, so all of them have been city bankers. Salim Raza is the former governor of the central bank, as well as Citibank, and Pakistan Business Council has a lot to his credit. Thank you for giving us your time, Salim. Alman Aslam has been an ex-city banker, now one of the major advisors to many corporates. Is a very important player in the corporate sector. Shahzad Dada, President and CEO of UBL, as well as Standard Chartered. So has many things to his credit. So I think with this panel, discuss many, many issues that are going to be critical to us, to our system. So let's go there. First, let me show you a few slides. You can see the topics that we can discuss here. I won't read them, but you can see them. First of all, let's have a quick overview. We do this before every seminar just so that we can keep track of where we are. For 75 years, we've been begging. We have Gustav Papanek recently on our webinar to tell us how our begging journey began in 1954 when the USAID people came along, and we had no clue what our economic policy was. And that Papanek webinar is very, very important. You should hear it, what he has to say about Pakistan. Very good memory. This history is very important to bear in mind. There has not been a decade in which we've not had two fund programs. It speaks volumes for us. It speaks volumes for our policy. This is where we have been for the last, in fact, all my life. Every decade, we've had 2 or 3 programs, which is kind of disconcerting. That's why I put it up there. Our long-run growth is declining. Now we are into negative territory for the first time in our history, but even before that, our growth was declining. It has always been declining for the last 20, 30 years, maybe even 50 years. Our savings rate is well known, but it's worth keeping in front of us. And this is what concerns bankers. Our saving rate is very low, even compared with our peers, and it never improves. And what role does the banking play in that? We'll obviously be discussing that. Our investment rate is even more abysmal. So again, in a group of bankers and economists, etc., we should think about it. Why is our investment rate so abysmal? Our government is running around looking for foreign investment, but yet a domestic investor is not investing at all. So we should think about it. In our previous webinars, just to give you a little bit of a quick update on what our previous webinars, we had 3 of them with many eminent people like yourself, Khalid Mirza, and various commissioners and various people who have performed, Naseem Beg, etc. And everybody said that we have no financial markets. That our financial market, stock market especially, is very, very weak, to use a euphemism. And that banks are basically agents of government, and that the stock market is too shallow and thin, etc. Bond market doesn't exist. There are no real instruments. There's one REIT, despite the fanfare, there's only one REIT, and that happened after the fact, not before the fact. We did discuss corporates too. We had many good corporate leaders there, and they also agreed that there's no professionalism in the corporate sector, that there's no R&D, no innovation. Set culture prevails widely. There's no hunger for growth. It's mainly a hunger for SROs and protection. So there's nobody who's trying to build a legacy corporate or a widely held corporate like Microsoft or Apple or something. So that's also worrisome. Again, many people, leaders of the country, told us that our government policy is much to blame. Our tax policy is aggressive, distortive. Documentation is costly. You're treated as a criminal, not as a legitimate taxpayer. This is the only country in the world where the government is calling everybody a tax cheat. We have a volatile fiscal policy, many budgets, and too many budgets, and very reactive. The whole government approach is business unfriendly, and there's a suspicion of profit. So this is the background by which we approach this seminar. Everybody thought that the regulation was captured. Non-professional laws are confused. As the former CEO of the stock market wrote, that the stock market is run through a bedroom of a broker. This is from a Dawn article. We're a low trust society. There's very little trust left, and you can see that in the corona. So that is what we learned so far in our webinar, and I want to now get down to our panel, because this is about our panel. We don't speak much here. We let the panel speak. Since there are a lot of people, I'm going to direct some questions at you people, but please free to enter wherever you want to, because quite frankly, our view is that you have a lot to tell us. So wherever you feel the need, you just have to tell us that I want to speak, and certainly you can speak. You can intervene whenever you like, all of the panelists. So it's not that it's about you or whatever. So let me begin first with Salim Raza and Zubair Sumro. Let me ask them very quickly. When I ran this seminar, many people, first of all, in our seminars, we held many seminars of human resource management, and that's why I think that's become a critical issue we should talk about. That we train students and they don't find jobs. There's 30% unemployment rate among the graduates in Pakistan. So one thing that we discovered in our seminars was that Pakistan is talent repellent. And you guys are sort of evidence of that. You spent your youth overseas and came back later. And I did that too. So all of us basically in our prime years spend time outside. Now, most of you, in fact, I think all of you, are products of foreign banks. And all of you, I mean, at least 4 of you I know for sure, were trained by Citibank, right? Or maybe 5 of you were trained by Citibank. Citibank had that famous Athens Center where they trained people like you, and many of you benefited from that. Now, many of you out of that group are running banks and have been running banks for the last 15, 20 years. Many of you, some of you have even got into policy, like Salim Raza got into the governorship, Shaukat Tareen got into the prime ministership, Shaukat Aziz got into the, finance ministership, Shaukat Aziz got into the prime ministership. So when I ran the seminar, many people called me and said, hey, can't you find anybody else? Can't you find younger people? So my question, I'm throwing this question to you then. Are you guys, have you trained a younger counterpart? Are we going to see 10 years from now, your counterparts coming out of your banks? Because Citibank, etc., those banks have gone. All the foreign banks are still there and they're still more profitable than you. So can you answer that, Salim and Zubair? Salim?
Yeah, I'm off. I don't know if you can hear me, but my screen's gone blank. If Zubair's there, could you start?
We can hear you. We can hear you. Can you hear us?
Sir, sir, he's
Hello?
unable to see the screen. Mansoor is calling him, sir.
अच्छा
Okay.
चलें करें
All,
हाँ Salim, we can hear you. Go ahead.
all right. So, so the question is, um, the foreign bankers had a role to play, and now what's happening now in the banking sector in terms of caliber, quality? Well, um, remember that for 30 years we had a nationalized banking system at a time when foreign banks were allowed to operate. And obviously, foreign banks invested a lot in training, but they also took big chances on their people through delegation of authority and through a clear demonstration of merit in terms of how people were moved on. So there were three things, I think, um, that marked foreign banks from the Pakistani banks of that time, the time of the nationalized era. Delegation of authority so that you had incentive, training, adding to your skills, and merit so that you appreciated um, or you understood, what where the rewards came from, and you didn't resent anyone else's promotion over yours, or try and lobby, or play politics because it was all done arm's length. So there was a lot of monitoring. There was a lot of a number of reviews, quarterly reviews of performance. So that combination of things did give foreign banks, I think, an edge. And therefore, when our system started privatizing, the new banks picked up a lot of people from the pool of foreign banks, which at that stage there were over a dozen. I think there were about 14 foreign banks. They're down to 4 or 5 now, of which only two, a couple are really active. So now, for the last 20 years, we've had privatized banks. I'm sure people I've come across who've grown in the domestic system are good. In terms of training, in terms of uh, delegation of authority, and in terms of perception of merit, within the organization, I leave that to the people who are now running banks to answer. And maybe Zubair can talk about that a little more, because I think, without delegation and without perception of merit, you will not get the kind of initiative and the sort of incentive to apply yourself and grow, diversify the business, add dimensions to what you're doing, that private incentive, personal incentive, you won't get that. But I'm not in a position to say how well uh, in the banks as we have them today, how well that is operating. Zubair may have comments here.
Fair enough. Zubair, can you tell us where will we find the younger Zubair Sumros and the Salim Razas in the current banking system? And are they going to be domestically trained? Are you going to go outside and look for them?
Nadeem, I don't think there is a shortage of talent. I think it's an issue of, there are two critical factors. One is attracting and retaining that talent, both domestically and overseas, from overseas. Let me divide my comments into two parts. One is attracting talent for the public sector banks. Now much fewer in number, but still say 20% of banking system assets. I think for the public sector banks, what has changed is that it is more difficult to attract people into the public sector banks. The governance standards have been impacted. The ability to choose your right team right at the top, meaning at the board level, it all has to go to the cabinet. There is more bureaucracy in it. There are the issues about in the public sector of being hassled by NAB and the FIA, the judicial activism, when ex-PI chairmen were lined up before the Supreme Court, like a bunch of little boys, hearing after hearing. These things have discouraged people from heading towards the public sector. But still, in the public sector, we are finding at National Bank, it's not as easy as it was before, but we can attract talent. We have been able to, you know, at one level and two level below the CEOs. In the private sector, it's, you know, I think the SATE culture, you know, the issues Salim was referring to have both the delegation of authority and decisions made purely on professional terms. You know, it has been impacted by the SATE culture. You know, some of those bigger banks that are more professional, you know, have still benefited from being able to attract talent. But right now, you know, our opportunity to attract talent should be much greater, because banking systems overseas, you know, there is throughout the Middle East, for example, and beyond that, there is pressure on banking jobs as economies are suffering. So if we can reposition ourselves now, and I think, you know, one point I'd make in this about attracting people back into the country, this whole unhealthy emphasis on the issue of dual nationalities or people coming back who may have changed nationalities. I think this is unhealthy and discourages talent that is both required and, you know, that will be professional, and there is no need to mistrust them. I think we lose people because of that. This was not the case when I was at UBL 20 years ago, but it is a case now. So I think now our challenge really, we can still attract talent, although it's more difficult. Retaining that talent is more of an issue. In the private banks, it is the SATE culture allowing effective delegation. In the public sector banks, it is the fear of government investigations. There are ways to manage that, and we are dealing with it. But, you know, in summary, I'd say, yes, the talent is there. We can still get it, but with more difficulty.
Okay, Atif and Shahzad, you can address that question too, because I think it's very important. How do you address talent merit in your banking systems? And in particular, I'd like to hear about the training efforts. I mean, Athens, the training center of Citibank, really created leaders for us for a long time. Are you banks investing in training? I've checked and I can't seem to find any training centers by banks. I can't seem to find any concerted effort to train people. I've talked to many of your managers, obviously selected because I only talk to the managers I deal with. And they are not too happy about the training. So please, and I've seen CCP also had a note on this, on the professionalism and training in banks. I've seen a couple of studies that have been conducted on this. Not very good studies, but at least pointing in the same direction. So Atif, can you talk about this, about human resource management, your ability to create leaders, the finding younger Atifs, and the training of your banks?
Dr. Saab, thank you. I think, you know, a couple of things that I want to absolutely agree with that was said before. Zubair said there's a lot of talent in Pakistan, and I 100% agree with that. And we have, in the banking sector, our own local banking sector in the past have shown that we have been able to nurture that talent and create some of the best bankers, even though they didn't always come from the foreign banking community. Now that, I think, was an era where I think Pakistan stood out in professional culture part very strongly. And, you know, we've always said that Pakistan produces very good bankers. Unfortunately, the institutions that produced those kind of bankers locally went through a process, whether you blame nationalization or you blame other forces that brought professionalism down, had a huge, you know, took a toll on the training part. The talent is there, but the training and the nurturing of talent just did not happen, except for the foreign banks, where, as was already said, I won't repeat that there were reasons why foreign banks stood out in terms of creating talent. Now, as the foreign banks have exited Pakistan, that national training ground for our professionals has reduced, and the local banks, unfortunately, have not taken up that challenge. and have not upped the game in terms of training and creating the right kind of cultures for the right leadership to develop. And part of this is what Zubair mentioned is the sponsorship that the banks have ended up with have not seen the value, I guess, in creating very professional cadres of bankers. And so if you look at training budgets and training center developments, you'll be disappointed. One of the things that I have been seeing and arguing against happening in our own bank is the tendency to cut training budgets whenever there's a pressure on costs. And this is something that, just recently we're going through. We've cut down our training budgets, and now we're trying to see how we can rebuild that. So I absolutely think that the local banks need to fill that gap, need to spend a fair amount of money, and the boards and sponsors have to support that, because this is a business, this is an industry where the only real asset long term is people. And we've also seen and some very good examples where I think the quality of management and the longevity of management and management strategies has shown success. And Mizan is a great example of that. So, they've got a model, they've got a management strategy, and they've stuck to that for a long period of time, and they've developed people within that, and they've seen the successes that have come with it. And of course, there are some other banks who are trying to do this, but your point is right, that local bankers need to step up and really focus on building people and the leaders of the future.
Shahzad Saab, where will you find the younger Shahzad Bajwa? Where do I find the champions that I can call to the next seminar to talk about, the future of the banking system? And
no, thank you. First of all,
engaging enough in training? You go ahead.
Yeah, thank you, Nadine sir, and thank you, PIDE, for giving me the opportunity and to be with this such an august panel. But I agree with you. I think we have, training and development is not something that comes naturally to us, and we don't, as Atif was saying, the investment in that field has been quite feeble. If I break it in two parts, the first part is, I think there's definitely first an acceptance of the fact that yes, we have, we are trailing behind, and there's really a need for improvement. Having said that, I think what I've seen, the current regulator is also very focused on this thing, and the current leadership. And I think what they are doing is, through IBP, which I'm a council member of, and Atif is also, and some others have been involved in it for periods. I think that's something that we really have not nurtured it the way it should have been nurtured. And there's a lot of room for improvement, because that could be the uniform platform for bankers to get training, and not just training as an incoming banker, but throughout their careers, that they can go in and out. And I think because of not such a great center available on a common platform, banks started developing their own training centers. And you're right to point out that you have not been able to find out, but big banks at least all have built their own training centers, and they all are running it. But with economies of scales, and I think that's something we are lacking. We are not able to get people like Zubair Sumroz and Salim Razas who can come in and share their experiences, their knowledges with the younger generation, and I think inspire them and really mentor them. So I think ek to ye. Dusra, I think organizations like all the banks in place, I think the clear emphasis on a learning culture. And I think that is something that banks really have to focus on, because after all, our biggest asset is our people. Every evening in the elevator banks or through the staircases, we lose our talent, and we don't know if they're going to come back or not. So we really need to ensure that continuous learning is happening and they are there. So there's definitely a learning culture. And I think this opportunity of digital era that we have really leapfrogs us and what we can do on that front. And I think this is something that we really need to take advantage of, because today you can do learning anytime, anywhere, any place, like banking effectively. I think with your smartphone, you can effectively get any training done through various portals that are available, and banks should really, and it has reduced the cost per session or per training. Coming a bit closer to our bank, Standard Chartered, what we have been able to do is we very early on decided when I sort of came over that I think we need to promote from within. So 70% of our VPs are promoted from within, and 50% of our cross-functional promotions. So it shouldn't be that a corporate banker has to be a corporate banker for life. He or she can be doing operations. He or she could get into compliance and cross-fertilization, and foreign banks really do that. I think we really need to encourage that across all platforms and really give make them a complete, a well-rounded banker. And I think that's worked well for us. Then, like I said, we've been doing a lot of distance learning. Even in the COVID period, we have been able to do a learning week every year, but then we have continuous training. So I think that's something we all can do. And I think the other point which you were earlier asking to Zubair Saab and Salim Saab about this point about talent train, I think this could also be an opportunity to us. We all know there's slowdown globally, and I think brain drain or talent drain jo hamara ho raha tha bankers ka, a lot of them are going to be in this market, and we can really nurture them and make sure that they can become the future Salim Razas and future Zubair Sumros, right? So I think that's something to be done. One other thing I think we don't give a lot of emphasis to within organizations as part of a learning culture is succession planning and mentorship, and really providing them a matrix and sort of people forums in which we really can earmark them for the next 5 years and next 10 years. We are not, as a nation, also very good at long-term planning, as you said earlier on also. And I think if this is something we do, picking the future leaders and really honing them, developing them. But what I am optimistic about in conclusion is I think a lot of focus has been given on it. And frankly, banks that do not do this will be the net losers, regardless whether the public sector, private sector, state, non-state, because this is the biggest asset. Thank you.
Alman, can you please get to this? You are on bank boards. You have been involved in bank governance. You have been a banker. So can you please tell us what Shahzad raised was a very good point about the learning culture. So most banks outside give us research on the economy, give us, all kinds of research on corporate finance, on corporates. Pakistani banks are singularly silent on this, and they don't do anything. And the learning culture is a thing that I'm very interested in, because I think in Pakistan we don't have a learning culture. But secondly, Ulman also talk about this, that the wage structure for Citibank, from what I remember what Salim just said, was a little more compressed than it is today. Today, what I see in banks is this curve that I there. It is this curve that is kind of very, very convex, where the top people get everything and the low grades, they tell me they don't get anything. Is this conducive to, good staff behaviors? The people who come from outside get paid far more than local. So I want you to comment on this and the HRM in banks as a board member, as somebody outside the banks. Go ahead, please.
Thank you, Nadeem. Look, I've always believed that things are done when there's a need to get them done. Mm-hmm. So Citibank took people from Pakistan and trained them because they had a huge need at that point in time in the Middle East, because the Middle East was exploding. So Salim, Zubair, Shaukat Aziz, they were all hired in Citibank in Pakistan, spent a couple, 5, 10, whatever years, and then went off to the Middle East because they were just sucking in people there. And that's why the training centers were created in Athens and so on and so forth, because there was such a huge need for that. In Pakistan today, I think the issue is that, as Salim pointed out, that the banks were privatized, and so they became much more efficient, and the foreign banks therefore found less space to work in. And then let's take a look at the environment in which the privatized banks are working right now. The majority of their income, or I won't, maybe majority is too strong a word, but a large bulk of their income comes from investing in PIBs. So the profitability is really coming from investing in government paper. So they have, right now, I'm sure, though I haven't seen I've been off the board of the bank on whose board I was for the last 2 years now, so I don't monitor the numbers that closely. But I do know that at that point in time, PIBs were becoming scarcer because government wasn't issuing a lot of them. Now in the last 6 months, they issued huge amounts of PIBs at very high rates. So the banks collect deposits from customers, collect a lot of NIBs, and they put them in PIBs, and that's it. And now when the interest rates come down, they're going to sit on huge capital gains. For the next 4 or 5 years, the banks are going to make a fair amount of money because of their PIB portfolio. Now, in this environment, the incentive to build lines of business in which you need training, product development, all sorts of investment, the incentive isn't there, because if you are going to go out and develop a credit card business or a SME business, there's a long ramp time. You have to train the people, you've got to put in the system and all that. But why should you do that? Why bother? Because you can make a lot of money just putting money in PIBs. So as long as the government fiscal deficits are there, and the government is the major borrower in the banking system, there is no incentive for banks to go out and train people there. Yes, there are bankers like Atif and Shahzad who have come from a culture where they've learned that training is important and they need to do it, and they're pushing it in their banks. Aurangzeb, I'm sure, and Habib Bank. All these banks, they've come from that background, they've come from that culture, and they know it's important in the long term. But what is the long term and what is the short term? Right now, in the next couple of years, the banks are going to make money off the PIBs, of the capital gains. And then when that expires, then they'll say, okay, now let's figure out what we really need to do. And yes, there'll be a dip in their incomes because they will not have products developed, but they will come around and get it done. So that's my take on why things are the way they are. The wage structure in the foreign banks has been distorted. And again, the younger people on the panel today, Atif and Shahzad, can speak more to it than I can. But from my time, what happened is when the investment banks and the commercial banks got together in the West in the late 90s and early 200s, the investment banking wage culture came into the commercial banks. Commercial bankers weren't being paid the kind of money that investment banks were. So when they were put together, the senior people in commercial banks suddenly started seeing their remuneration shoot through the roof. And I think, and then when we in Pakistan started hiring CEOs from abroad, we had to benchmark against those numbers. So the senior people in the Pakistani banks also there's a legacy now, because they all came from outside where they were being paid very highly. So that's there, and then there becomes a large gap between them and the younger staff. So that's what I have to say, unless you want me to add something else.
So anybody else want to say anything? Atif, Shahzad, Salim, Zubair? I think Alman has painted a very good picture that since it's so easy to make money, why invest in human resource? Why invest in product development? Why move on? So the government, maybe I should put it this way. Is the fund right then that the central bank should not lend to the government? Perhaps the central bank
no.
the government. Go ahead, Salim. Ji?
Salim is frozen, I think.
Oh, okay. So is it...
Sorry, can you hear me?
Anybody
Sorry, is my voice coming through?
Ji, it is coming. Anybody can take it up. Do you think it's better that the fund recommendation not be taken?
Yeah.
Central direct. Go ahead, Salim. Go ahead.
Sorry, what's your question? Could you repeat that? There's been an interruption.
The question is, Alman has painted a very good picture that it's easy for banks to make money being bankers to the government because it's risk-free, it's high return, and you have to do nothing. So quite frankly, the bankers have to do nothing except buy PIDs and sit on them, and you've got guaranteed profitability. So in that case, is it not better for the central bank to
All right.
Go ahead, G.
If you allow me 5 minutes, first of all, you pointed out that we have the non-commercial bank financial markets in Pakistan are tiny. Our development finance banks are very small. Zarai Taraqi Bank, Housing Bank, SME is moribund. The investment banks are small in the by and large length. There's not really investment banking going on there. Our stock market raises less than 1 to 2% of the amount of debt raised by banks. So it's not really playing a role in capital formation. Bond market is small and illiquid, and we don't have an infrastructure financing. So we then look at commercial banks as the central source of debt provision, whereas in other markets, these other entities that I'm talking about have a strong role to play, and they supplement whatever commercial banks do. Sometimes they lead the way and commercial banks follow. If you're going to develop an SME market, if you're going to lend to agriculture, where it really needs financing, if you're going to invest in cold chains, in warehouse financing, that in better seed, in better fertilizer, all that needs spending. And the private banks are not going to go into long-term lending to agriculture. They're not. But if that framework had been set up by development finance institutions, then commercial banks would have come in. So we have to bear in mind that we are asking private banks really to do a little more than they would typically be required to do. There are other institutions that we have not created. We have market failure. I think we have to recognize that. The other point about excessive government debt with banks, absolutely right. But whose fault is that? Privately owned banking system, which is rare, by the way, if you look at other development markets. If you look at China, look at India, look at Korea during its growth phase, money is in the World Bank, all public sector. And they go in for infrastructure, they go in for SME, they go in for agricultural development, including agricultural infrastructure. Now, having said that, let's return to our banks. So let's go back to government. So that's market failure. The second market failure is that the government pays more for 3-month paper, treasury bills. The government pays the banks more than the banks pay to raise money from the market. Tell me what sense that makes. I mean, should the government be the benchmark, or should big Pakistani bank be the benchmark of the risk-free rate? The government is meant to be the risk-free rate. So let's accept that that's market failure. How does the government address it? I can spend time on that, but let's leave that. Funds. It's basically funds. Why would I, as a depositor, get 7% on 3 months money from a bank when I could get 8% from a treasury? Because you haven't got, or 8.5%, because you haven't got the funds playing that role. Money market. As you know, in America, they're almost as big as us. Anyway, there's been no effort to move in that direction. So revival of development finance institutions, be they public-private partnerships, be they in the public sector, that's secondary. They have to be independent. Boards have to be independent, and you have to have professional management. You need to revive that, and the government has to think of other alternate forms of borrowing. Now, having said all that, let's get back to banks. There are 2 alarming developments in the banking system, which now, so I've forgiven banks for a lot of the sins that they're accused of. Let's look at what they should be doing. There are 2 alarming developments in recent years, in the last decade, which have been accelerating in the last 3 or 4 years. The first is our banking system is small, 33% GDP. India is 64%, Bangladesh is 47%, developed markets well over 100%. So our banking system is small. But against a small banking system, we've had a massive ramp up in cash in circulation as a percentage of deposits. Now, you understand what that means. cash leakage or cash not coming into the banking system mutes the capacity of the banking multiplier to expand deposits. Because banks make money through lending money. It starts with deposits, then loans are made, which become deposits in other banks, and the process goes on from there. Now, our cash is 43% of our bank deposits. A decade ago, it was 27%. Now, and what should it be? Well, developed countries, it's low single digits. India, Bangladesh, 14, 16%. We are off the screen in terms of the amount, even compared to emerging markets, in terms of the amount of cash in circulation as against deposits. You mentioned some reasons for that. There are fiscal reasons for that as well, but there are other. The fact is, it's an issue that has to be addressed. So if we were at 27% cash to deposits, today our banking system would be not 14. Our banking system deposits would not be 14.5 trillion; they'd be 22.5 trillion. So there's 8 trillion that we have debanked. Let's not ignore that. We have debanked. We're not expanding our banking system. We're potentially contracting it when cash grows faster than deposits. You're potentially debanking. What can be done about it? Well, let's leave that aside. That could be a subject in itself. Fiscal policies certainly have something to do with it. The state banks should be taken. Interest rates do not have much to do with it because the fastest ramp up of cash has happened in the last 2.5 years at a time when interest rates have been the highest. So to say that banks don't pay enough, not true. Banks were paying very large amounts. And while what banks paid was increasing, money was continuing to leak out at a faster and faster rate. So this is a kind of market failure. The second is private sector credit. A decade ago, our private sector credit to GDP was about 28%. It's now 17%. Now, banks can say, all right, government takes almost half of our loanable assets go into government securities. Another about sort of 15% go into government guaranteed debt in one form or another, commodity lending or financing IPPs, etc. So 2/3 of our deposits are locked up in government securities, and for the rest, we find that the private sector, good companies, large companies, emerging medium-sized companies, they're there for us to lend to. So yes, we do lend to SME and we do lend to agriculture, but we know that we just touch those sectors. We are not playing any transformative role there. And if they're not, then credit growth is going to be muted because the bigger companies' needs are limited. The banks can earn more from the SME and the agri sector, but why should they expand there? It's high risk. So while they have the alternative of going into government securities, they're not going to go into development finance, nor are they going to go into long-term infrastructure finance without government guarantees. There is no proper project finance in this country. And I'm not talking about financing, a mill's expansion. I'm talking about financing road, bridge, a power plant. And there is no proper infrastructure finance here because banks lend, but they lend against government guarantees. So that's not financing infrastructure. Anyway, I think I overshot my time, but I wanted to put things in perspective. There's market failure in that banks are not being supplemented. And we expect banks to do too much. There's market failure in the way government borrows. And there's market failure within the banking system where I would ask the banks what they're going to do about this. Because we must be one of the only countries in the world that has a potentially contracting banking system as a percentage of GDP. Anyway, I stopped with those observations.
They're all very valid points. I think that they're all very valid points.
Nadeem,
Taken up. Please, Zubair, go ahead. Zubair, go ahead.
A few things. You see, while banks have had this easy ride now for a couple of decades of investing heavily in government paper, and now with interest rates having come down, the next few years with capital gains, look very easygoing also. But actually, there are some major strategic issues to be thinking about. For example, in this period, they have not really kept their eye on the ball in terms of all these earnings through government paper do not require investment of heavy expenses. And yet our systemic cost to income ratio is much too high. So they have grown their costs, not where they are making their money, which is government paper, but in a whole bunch of other things. And those things now need addressing. And in this COVID period, where non-performing loans are going to go up very substantially. And the skill set required for that, as well as to grow the underserved sectors, those are things that, maybe the likelihood is that they will be deferred out on a systemic basis. But this is the time that we should be thinking about developing skills within the banking system to deal with these issues.
Good point, good point. Anybody else? Then otherwise, let me turn to this thing. One of the reasons, Salim, as you said, that banks are kind of...
Can I?
Yeah, go ahead, go ahead.
Sorry, Nadeem Saab. I totally, the points that Salim Saab and Zubair Saab are making are very fair and definitely structural points. But I think we also cannot lose sight of the fact that if you look at our documentation of economy, it's the lowest in the region, if not in the world. If you look at just our tax to GDP, we are 13%, 10 to 13% where we hover. 1.5% of our population is paying taxes. And in light of that, if you look at our total estimated SMEs, which are 4 to 5 million, only financeable, only ones that one can finance is 100 to 150,000. At the same time, if you look at the policies, and this is again what Salim Saab was referring to, there are lots of gaps there, and even Zubair was referring to it. Just look at total number of households, 32 million households, of which mortgages are around 70 to 80,000, because there are some structural issues on litigation. You get decree cases which you can't even repossess. The repossession law is absolutely ab jaake usme, after a lot of effort from the banking circles and all usme aaye. So I think we also have to address those problems because as Alman earlier said, need will drive banks' behavior. And I think we really need to address these gaps. And you're right, Salim Saab. I mean, 40% plus of cash in circulation. Aapne sak kar diye 40, it's a very cash-based economy and reflected on this SME. And I think this COVID situation has again highlighted that this is the first time we have a catastrophe where both the formal and the informal sector is getting impacted. But the bad news is the informal sector is the one where there's the most amount of employment. So its impact is far greater at the grassroots level. So I think these are things also we need to keep in mind. And in a very small way, LSM growth happens because if these SMEs start getting documented, and I think through some of these deferral programs and all, we are seeing a lot of them coming forward and sharing information, which frankly for some of our banks has been an eye-opener, right? Their actual accounts and what they are sharing now are completely different. It shouldn't be a surprise to all the people on this call because we know there are dual books and all that, but I think this is what's amplifying. And now we have that data. When things normalize, we can really bring them into the text net, and they can also benefit by getting the exposure to banking sector and the products and the services. And the ones who will give it to them will be the winners because other sources of income hopefully will dry down because the government will not be the only lender. Last point, IFRS 9 will also change the behavior of how we invest in government securities. For foreign banks, we've already adopted it because of our international regulators. Local banks, this was going to get adopted earlier, but it has been delayed. And once that gets put, risk-weighted assets ki calculation mein aapko dekhna padega. It won't be a simple game of zero RW and you get those returns.
But
Doc,
go ahead. Go ahead. Go ahead, Atif. Go ahead.
I think then a number of good things that have been said macro level pe aur kuch ecosystem ke baare mein like Shehzad had also mentioned that the ecosystem has got its problems, and the failures and the distortions that Salim mentioned obviously drive what the banking sector does. But just like to also point out that when we say that banks make a lot of money of low-cost deposits, that's absolutely true. But if you were to try to just distinguish the kind of businesses that banks run or are supposed to run. So the treasury piece is the one that we've talked about, where you get funding from either deposits or elsewhere, and you put it into government securities or and primarily government securities, because there are no other size investments available. And that, because of the distortions that Salim mentioned, gives us a return that is not fair, perhaps, because you're getting a higher reward for a lower risk, which should not happen. And so why that happens, Salim touched upon, and I don't have to repeat that. The other businesses, in discrete, to be simple, are the corporate business, then there's the SME business, and then there's the consumer business. Now, that in a graduating sense requires more capital, more investments in technology and systems, more investments in people, more and different skill levels. And increasingly that becomes more complicated and more expensive from a capital point of view and an operating cost point of view. And increasingly important is that the risk charge goes up. It's riskier to move from treasury to corporate to SME, and then to consumer. And the capital allocation for each one of those businesses is also starts increasing. So now, if you were to look at banks as rational commercial beings, where should you invest your capital? Where the capital involvement is low, where the returns are high. That automatically goes into the treasury business or the corporate business. So the banks that actually say, okay, now we have a greater role than just to make money off these distortions in the economy, we must go for SME and agriculture, we must go for consumer. Those are the banks that are actually taking a much greater risk and really taking a risk on the back of the sponsors or the shareholders. Now, the incentive to do that is actually not clear, even from a regulatory point of view or from accounting standards point of view, because if I want to do the right thing and put money into SME business segments, I have to actually allocate more capital, and I have to take greater provisions, and I have to take greater costs. So there should be some kind of incentive that is clearly defined for banks who are willing to do that kind of thing. And that is, I think, not understood, because when we get rewarded as an institution, we're either rewarded in the stock market by the stock price going up, and unfortunately, the sponsors and the shareholders don't necessarily reward you taking those incremental risks and incremental costs, because that takes a long time also to get returns. The gestation period is also long. So, I think the banks that are able to continue to open branches, and I know there are banks who have this as a stated strategy that we're opening branches just to get cheap deposits, not necessarily to lend in the private sector, they get an undue advantage in terms of profitability and in terms of return on the stock market. So I think there has to be some degree of balance, and this is where the a more detailed discussion should have, and more research should come about to guide perhaps the policies and the regulator side and the government side. So that was a key point that I thought I'd for everybody.
Let me just say this then. The impression that we get from the outside, and I want you to comment on this, is that perhaps the banking sector is too protected. Perhaps the banking sector does not have enough competition. It has the first dibs on government securities. It is the first dibs on loans. It has so many advantages. First dibs on the commodity finance, which is a very comfortable, cushy situation where you get 2% above KIBOR. The government, in fact, Salim was saying about government be the risk-free borrower. Here, the government borrows at a higher rate than the corporate. But more importantly, look at the corporate tax, the pre-tax return on equity in banks. And it has long been argued that banks are highly profitable. They've been subject to super taxes and things. So yes, we also see that market share of commercial banks. I mean, there's a great degree of favor for the larger banks. In fact, the banking system is getting more and more consolidated over time. The smaller banks have no way, they're getting squeezed out over time. And the consumers have really not benefited. The spreads remain the same. I remember I wrote a thing on the financial sector for ADB a long time ago, before the privatization. The spreads remain virtually the same. Even after privatization, spreads have not gone down. There's remained roughly about 5 to 6%. So the question is, I want to roll in a number of questions for the interest of time. CCP also, Competition Commission of Pakistan, also did a report, and they are ready to do another one, they told me yesterday, on the competition that the banking system faces. I think former governors have also made sure that NBFIs have been squeezed out of the system. There used to be some NBFIs, now NBFIs have been squeezed out of the system. We also see that banks take money from the poorer districts and all the money comes to Lahore and Karachi. So the large banks and national banks act like a vacuum pump from the rural areas to bring them into the cities. Now, I want to ask you 3 or 4 questions. Also, the other thing that even CCP and many people are concerned about, have banks become too comfortable, too stodgy? For example, your tech or innovation capacity is very, very low. Your ATMs don't seem to work very well. Online payments are very primitive. It's very difficult, also costly. The fees are very large. So the question that I want to ask you is, are the mobile companies going to take over? Are they going to take over banking while banks sit there comfortably? 1. 2, should we have more NBFIs? Should we have regional banks? Salim talked about DFIs. Why not regional banks? Why not, for example, credit union? When I worked in Washington, I had only one credit union account, no commercial bank account. Cooperative societies, building societies. There's so many other forms of banking, which state bank does not allow. And entry into the banking system has been disallowed for the last 15, 20 years. Can new private banks come in, or is the capital requirement too high? So, Alman, maybe you can begin there since you stand outside the system, then we can go to the others.
Look, as far as the competitive environment is concerned in the banking system in Pakistan today, Salim is, I think, much better equipped to answer that, but since you posed it to me, I will. The situation as you look at it right now is that the smaller banks do not have the capability of raising funding deposits at the same cost at which the larger banks can, because the larger banks have bigger branch networks. And then when they take in that cheaper cost money, then I go back to my old thing of them putting them primarily into PIDEs and government backed loans, so they make the spread. And the smaller banks, because their costs are higher, they can't deal with that. And then the second thing is that because the larger banks have lower costs in terms of deposits, they can lend at finer rates to the large corporates, because everybody wants to lend to the large corporates, because that's where the risk is lower. And the smaller banks are unable to be competitive at those rates. So what they do is they tend to go into the higher risk assets. And when they go into the higher risk assets, then they end up getting non-performing loans. And then their ability to, the smaller banks, their ability to attract talent for risk management and whatever else is much more difficult, because that talent has become expensive. And they didn't have the cost capability of doing that. So that is kind of, at this point in time, loaded the dice in favor of the larger banks against the smaller banks. But your question about alternate forms of borrowing other than the commercial banks, you've got to look at it around not from the perspective of the issuer or the borrower, but from the perspective of the depositor. The various forms in which you can raise funding is not just bank deposits. Insurance companies, for instance, are usually the providers of long-term funding, because insurance companies by nature want assets which are 40 or 50 years in length. Commercial banks by nature, since they raise their deposits are shorter term. Their lending also has to be short or medium term. They go out 7 to 10 years. But the insurance companies who are funded by pension and pension funds, those are the ones that provide longer term financing, because that's the nature of their deposit base or their investor base. Now, we don't have those here. Our insurance, life insurance, is dominated by the state. You've got the state life insurance. I think there are only, to the best of my knowledge, 2 or 3 private sector insurance companies. One is, I think, Adamji. I think EFU has also got a life insurance business. But if you were to privatize the state life insurance company and life insurance and pension funds started developing, then you would find an alternate institutions developing, which would then compete with commercial banks, especially at the longer term end of the market, which the commercial banks are not equipped to do. Your issue about distribution of funds, that the funds are sucked in from the rural sector and put into the urban areas or into large corporates, is the same thing, because banks are going to lend where the risk is lower. Shahzad was talking about SMEs. The loss ratio in SMEs in Pakistan is 40%. Why would I go into that business? Although that SME is the backbone of any economy, but I'm not going to lend there, because why am I going to lose 40% of what I put in, and I have to develop systems and everything else good, and I don't have a legal system. I remember talking to one banker who was really trying to push SME, and he said, look, if you can somehow help me get into some influence level on the police, so that when I do even get a decree which I need to execute, I can get the local police authorities to go and help me get it done. It can't be done. So the legal system won't allow banks to lend. You have lending to corporates because that's easier to do. You have an explosion of lending to cars. Why? Because they have 2 keys. One key is with the bank and one key is with the owner. If he defaults, you just pick up the car. And somebody talked about mortgage lending. There's a huge demand for housing finance in this country. The demand for housing is enormous. But try to go and get an execution done on a mortgage in the courts here. It's going to take you 10 to 15 years. It's useless. So I think the legal system does not help, and there are pockets of the economy which are still dominated, the financial sector, which are still dominated by the state, which just distorts things. And those are things which cause, amongst other distortions, the distortions in systems. That's all.
Mm-hmm. Okay. But Atif, can you tell us, why is the banking system not innovative? I mean, I can accept all this. I agree that there are risks to be taken, etc. But the whole purpose of the banking system is to develop products for risk management and to be able to finance products. I agree with you. Okay, the PIDE rate is 13%. But I think private equity in Pakistan charges like 30 or 40%. So why can't you cash into that market somehow and develop new instruments? Credit cards offer you about 20, 30%, right? So credit card also, okay, it's an international franchise. But is there nothing that the domestic banks can innovate? After all, the telecom company...
Sorry.
Go ahead.
The short answer to that is, of course, they can innovate and they should innovate. But as we've been discussing, I think everything is stacked against that happening, because one, we started the conversation based on talent. And talent development is essential to innovation. And that, no need to repeat all of that is not necessarily happening. It is now beginning to, as far as technology-oriented solutions are concerned, that's beginning to rise. And I think there is some innovation coming in on technological solutions, whether you call it digital banking or digital solutions overall. So I think there's some innovation coming there. In the structuring of credit, the biggest issue in this economy, I think, for banks is the mispricing of risk, as we discussed already. I mean, if you're getting a high reward for a low risk investment in the government, the risk is completely mispriced. And when there is mispricing of risk, it's very difficult to create a market and an environment where you can create products that can intermediate between the suppliers of money and the needers of money. But having said that, there's still a lot to be done. So, for instance, most lending, even in the private sector or the government-backed lending that was spoken about earlier, is through bilateral loans or some kind of club deals with banks, which are not investment banking deals. They're just straightforward loans. And whereas the innovation should be to create instruments that can then be traded. So loan instruments, that can be market instruments, and then we have to create a market to make them tradable. So this is the point that earlier I think Salim made, that the capital markets, whether they're debt capital markets or equity capital markets, are so nascent in their development phase that we lose out on a whole capability. Alman mentioned the lack of access to long-term funds, which are generally available through insurance companies or through provident funds and pension funds. That industry is not developed, so therefore you don't have a large pool of long-term funds available that can provide a separate out-of-bank financing for infrastructure or longer-term investments. So I think there's a lot to be done. On equity side, you mentioned equity. Private equity is something that, again, from a regulatory point of view, there are restrictions. I know that I've personally tried to lead efforts to try to create private equity funds because when we talk about needs of SMEs or corporates, we always talk about lending. Debt is not their only need. A lot of growth companies require equity, and we don't have the capability to provide them solutions on the equity side currently, because one, there's no innovation, as you said. There's also a lack of regulatory support to create those kind of funds to create these entities. So I think there's clearly a lot to be done. Again, I think from Islamic banking की भी बात करते हैं, fundamentally Islamic banking is participatory, or should be participatory in nature. So that should lend itself to creating some kind of an equity fund vehicle that supports SMEs and growth capital requirements. So there's a lot to be done, and banks, I admit, have not done enough on that front. But also it's not just one-sided. I think the regulations have to be a little bit more forthcoming in this. And if I may just touch upon another thing that you've got on the slide, different kinds of banking. I think this is an important part. And as you said, you also, your first account was not with the bank, but with a credit union. That's, that's an important thing. We are actually in Pakistan kind of looking for banks, particularly the larger banks, to become kind of a solution for all kinds of segments and all kinds of products. And I think it's just not possible, particularly given the lack of resources, the human resource skills, the investment, and all the other issues we've talked about. It's just not really practical and possible for banks to provide holistic solutions to all segments. So for instance, microfinance is a segment that should be catered to by a separate set of institutions, which it is, by 11 microfinance banks and also MFIs. Now, the bank's role should be to provide them funding if we can, to support them. But very often we confuse the issue by saying, why aren't the banks getting into microfinance themselves? Because the banks just don't have that skill set, that capability. They're not designed for that. So if you're going to make a machine to do something else and then try to make that machine do some other task, it's not going to necessarily work. So I think we need to understand the differences there, and actually encourage the promotion of regional banks, microfinance institutions, DFIs for sure. I think Salim has always been talking about DFIs being critical to the creation of long-term funding sources. So I think that's a point that I just wanted to make. And one other thing that you've got there is the distribution from poor to rich. I think it's true. I think the numbers from the State Bank is that 10% of the total deposits are really coming from the rural areas, defined by them, rural areas, whereas only 4% of the lending goes to the rural areas. So that's a mismatch, clearly. But it's easy and traditional to blame banks for that. But as Alman said, try to find good, credible borrowers in those areas. It's not easy because they're not structured. They're not, the local environment or the commercials don't support them. So where it has to happen, it happens through microfinance institutions. So, while you can try to bridge that gap and bring it closer, but it's a current problem that is an environmental and ecosystem problem.
Zubair,
Nadeem, if I can, add a few things
Let me
on
just
this.
quickly add a question. Who are your competitors? Who are your competitors? And when Atif says mispricing of risk, isn't it your job to price risk, or should the government price risk? So whatever I have read in the literature, it's the banks in the financial sector that should price risk, and you have to do it innovatively. And so if you haven't, that is another failure that I put on your shoulders. Secondly, who is your competitor?
You see, Nadeem, just before I address that, if I can address what Atif just referred to and what Alman said earlier, there is a lot of misunderstanding about the SME sector. If you look at the State Bank's latest financials for the system, which is as of the end of March this year, that the NPLs in the SME sector was 17%, 17. The NPLs for the textile corporates were 15%. So it's not really that much out of whack. Now, at the same time, if you look at the SME lending, this is mostly S, but if you look at the SME lending by the microfinance providers, their loss ratios, even now when they are peaking, is 6%. So people within the system, within the overall financial system, have found ways to get into the SME sector at a much lower cost. And maybe that is the route to develop it, not the banking sector. But there's also another point that comes up when you look at that microfinance sector, is that the latest report on that, as of the end of March, shows that the microfinance banks and institutions have 50 million savers in that sector. And that's an opportunity for the system that is grossly underdeveloped, because those institutions don't have the capital and therefore the capacity to really develop that pool of savers that they have tapped. So I think these are things that we have to reflect upon. Now, when you come back to what is the competition, clearly for the big banks in this market, when the only interest for most of us is putting money into government paper, the competition for the rest of the business is not great competition. Making money has not been difficult as such. It's been made on the government side, but on the other side, we fund corporate loans, which is the bulk of the advances, on which we make no money at all. The spreads are minimal. So we really subsist, again, coming back to the government side of it. So the pricing issue is the distortions are there because of the dominance of government borrowing. 50% through government paper, another 10-15% at least through the SOEs. This is what leads to a distortion in the pricing structure, in my perspective.
Fair point. Salim, can we just quickly get from you a reaction? Why is it wrong then to say, I'm going to take a very anti-fund stance here, so tell me if I'm wrong. Should the central bank just lend to the government directly, or alternatively open up the PIB or the treasury market to all of us? I can buy it, you can buy it, everybody can buy it. Why should it be a banking monopoly, right? Secondly, why should the central bank be so restrictive on issuing banking licenses, especially when we are thinking of these regional building societies, so many other forms of banking? Why cannot there be a Gujranwala bank or a Jamshoro bank, right, which is restricted, which is a lower entry requirement, which just works in Jamshoro or whatever? Why does the central bank not want? I know it makes its life easy because banks then don't have to take much risks, but is that something you'd advocate?
Why would a Gujranwala bank or a Jamshoro bank behave very differently from what you just heard? While banking is a shareholder business, while banking is a shareholder as opposed to stakeholder, which it's not. In many countries, many emerging markets, it's dominantly a stakeholder business. And by stakeholder, I mean either government-owned or government-directed or serving development purposes. And, screw your spread. Now, we're not. We've opted out of that kind of system. Fair enough. That gap cannot be gap you're talking about. You can give licenses, but why do you think they behave differently? Why will a shareholder business be driven by any interest different from what you heard just now? Why will they go into long-term finance? Look, we've got these provincial banks. Bank of Punjab, Khyber Bank, Sindh Bank has been salvaged. I understand it's coming back into business. The government of Sindh has put a lot of money into it. What are they doing? Why were those licenses given to them? Licenses were given to them because they said कि government का पैसा ये बड़े बैंक खाट जाते हैं और हमारे they lend where they want to. हमारे यहाँ कोई development नहीं होता. So government deposits moved to them. These banks grew to a certain size. Provincial government deposits moved to them. Other government deposits. Then what did they do? They opened branches all over the country. They sold credit cards. They went into consumer loans. They tried to mimic commercial banks. Then why the hell did you give a provincial bank license? That should have been a strictly development finance license. That should have said your business is SME, your business is agri, your business is mortgages, housing. And the big advantage of that, if you're doing it through an institution that's dominantly government-owned, by the way, I don't know about the Bank of Sindh, but both the other banks, Bank of Punjab and Khyber Bank, have sizable private participation through the stock market. They're listed. Even if they're not listed, they've sold to private, a big part of it. So they're really public-private institutions. Now, if the government has the patience to wait, if the government has the capacity to move cheap government deposits to these institutions so that they have stable long-term funds. And if the government says this is your business, then these banks can work with government on all the regulatory changes. We were talking about mortgages. 0.25% of GDP is us. India was 1% in 2000. India is now 11% of GDP. Now forget other countries. Developed countries are still 50, 60, 70, 80%. But anyway, so 0.25%, you can't, and half of that is Islamic. Mizan has to be given great credit. Half of that is about 100 billion rupees, 110 billion rupees. Half of that is Mizan Bank, Islamic financing. Now, housing has a lot of issues. It has repossession issues. It has issues, if you're going to mass housing, it's got issues of who regulates the builders. Are there building regulations? Are there rules you can enforce on builders? How did India go from 1 to 11? They did three things. They formed the central bank, the Reserve Bank of India, formed a housing finance lending entity. I think it was called the Housing Bank. I forget the name, Housing Finance Company, HFC, I think it's called. It licensed local lenders. Number one, so you got a lot of local lenders for housing. Number two, it got regulation developed for builders. and developers. Very strict regulation, very black and white. So none of this business of of builders going in before buying lots of plots. I'm there examples here in Karachi, desert town. These guys go in, buy plots beforehand, wait, then start building for people who want to buy, wait for the prices to rise, then sell their plots. So they sort of rig the market in their favor. You need building regulation, very strong building regulation. So therefore, you need to work with government. And you need to have the preferred access to government and preferred access to people in the provincial government. Housing is a provincial subject, who will make those laws that accelerate the building of low-cost units. Which bank is going to finance a 20 lakh house? Because you're talking about somebody, a borrower who's earning 40,000 rupees a year. It's not going to happen. Our housing plan is not going to work. So anyway, so that's what India did. And then it gave fiscal incentives. It gave the developers housing, their income was tax-free. Borrowers could charge both. Now I'm talking about low cost, mass housing. I'm not talking about housing defense, which a bank can finance anytime. I'm talking about mass housing. It gave the builder tax-free income. It gave the borrowers the capacity, subsidized interest, but also if they were in the income tax bracket, it gave them the capacity to charge both interest and principal to tax. And then the repossession laws were sharpened, and and repossession became as simple as it used to be, even in Pakistan about 5 years ago, before this court judgment put the cat among the pigeons. Now, who's going to do all this regulatory business? Why would a private bank break its back trying to get all these regulations in place? What if you were a government entity or a public-private partnership, preferred access to government? Government would not see mixed motives in your appealing to government for these regulatory changes. You're more likely to get them in place, and then you're more likely to build a sustainable proposition around, just taking this example, around a proposition like housing, like mass housing. So we don't need new institutions. We need fine. The commercial banks are shareholder entities, fair enough. These development institutions that I'm talking about ought to be stakeholder entities, where the government does not doubt their motive, where the government trusts at least the objective, and it meets government's own plans in that area. Now these people will get cheaper funds from government. They will have a bigger capacity to take risk than pure private banks, because pure private banks won't do that kind of business. They'll have the capacity to lend long term, because they'll get cheap government deposits that are going to be with them for a long time. So we don't need new things. We just need to look at what we have and decide how we want to use it, and put some emphasis on the stakeholder, on those businesses, on those financial businesses that need a stakeholder commitment beyond just shareholder.
Okay, fair enough. Let me turn to my last question, then we open up the panel. I think corporate finance, the way I look at it, has not changed much in our lifetimes. Corporate finance still thinks, you still have commodity financing. People stock up cotton and you put a 20,000 rupee chowkidar there. You still stock up ganna and you still, finance working capital and, hardly any long-term capital. Can you tell me, all of you, has corporate finance changed much? Is there real corporate finance in this country, or are we just making it up? Alwan, do you want to go first?
Well, I don't know how you define corporate finance, but
debt and equity. So,
are you talking debt or are you talking equity? If you're talking
debt and equity, corporate finance,
let's talk about equity first. Now, the issue on the equity side is that there isn't a huge incentive for issuers to issue equity, because if you have a PE ratio, I believe today the PE ratio in the market is 4.5. The cost of raising funding by issuing equity is multiples of what you can raise money in the banking sector.
Then you're saying debt is cheap
in terms of cost.
Then you're saying debt is very cheap.
Sorry, I can't hear you very well. Say that again.
You're saying that debt is very cheap, so we should have interest rate at 25%.
I'm sorry. Well, no, yeah. If you If you really want to kill everything, go ahead. But when, if and when we've seen it in the past, when the first
Oops, Alman, we've lost you. Oh, okay, go ahead. Anybody else? Atif, you want to take that up?
Gee, I think we'll wait for Alman to cover the equity side.
Yeah. So on the equity side, something happened to my internet connection. So on the equity side, we saw that when we first brought the first foreign equity fund into Pakistan, it was a small amount, $22 million, and it was in the early 90s. The PE in the market just exploded. And I think we re-rated to about 12, if I'm right. And at that point in time, there were a large number of equity issuances done by domestic issuers, because they found that it was a very attractive source of funding. It was relatively, equity is always going to be more expensive than debt. It was relatively not that more expensive than debt. And obviously gave them a stable source of funding. But as the equity markets, like I said today, the market, I understand the P is down to 4.5. There's no incentive to issue equity. So as far as the equity markets are concerned, I don't think there's a great desire by issuers at this point in time to issue equity. When the markets start pricing properly, then that will be the case. Now, debt is in Pakistan is restricted, as you put out here, as commodity financing and short-term borrowing. Long-term debt, the knowledge that I have of long-term debt in this market was primarily driven by when the IPPs were introduced, and you had project finance being done to finance the big power companies. That too, the technology was brought in by I think the World Bank, and they tried to train people in NDFC, and I know Citibank played a major role in that. And that technology and knowledge then went into the private sector banks, and that still exists there to some extent. Other than that, in terms of
so if I can just go ahead, Alman.
Go ahead, Alman, finish. Then you can come in.
In terms of corporate finance, like I said, other than the short-term commodity and working capital loans, you have project finance, and the equity market hardly exists. So there's not much corporate finance done in this market.
Go ahead, Salim.
Yeah, a couple of observations. Into the tech sector, the new tech companies, Baikia, and then some of these fintech companies, Planet N, etc. About $200 million of foreign investment has come in, and this is first round venture capital, and then as you know, there's subsequent rounds, so the same investors will invest more as the business enlarges. Now, why didn't our people see that same opportunity? And why does all this money come in from experts outside, where our bankers, who are going to face competition from the fintechs, could have gone in as investors as well? In fact, what you asked this question, are the fintechs going to threaten banks? Well, they already are threatening banks abroad. A lot of the payment business, this cheap, easy business for banks, is moving out. From some data I saw, something like 20% of payment business was it the UK or US, I can't remember, has moved out to the fintechs, the payment business. I'm not talking about lending or any other product at the moment. So as far as the banks are concerned, why don't our banks now look at these fintechs, who in time will become competitors, and at this stage decide whether they want to acquire them, partner with them, or wait till they've got big and a really serious irritants for competition. So that's one point I wanted to make, because I think it's a very attractive area, and I think our banks should have a little pool of their own private equity. to dabble in this market, in whichever aspect they would choose to. The second point I want to make, we keep talking about long-term financing. I think Alman mentioned that the government has shifted its borrowing to about 2 years ago. The government's borrowing was 70% under 3. The average majority of government debt was 1.25 years. In India, it's about 10 years, for example. It's predominantly long term. So ours was predominantly short term. It's shifted. We have issued a lot of long term debt now, PIBs. I'm talking about government. But this is floating debt. Most of the long term debt that the government's issued have been floating PIBs, and they're repriced every 6 months. So as the 6-month rate comes down, they're not. No. So to build a bond market or to build a long term lending market, you need a big volume of long term government securities in the market that can be used to hedge your long term rate if you're a lender. And without that, without a risk free sovereign yield curve of different maturities, 3 years, 5 years, 7 years. Without that, you cannot create a reliable long-term lending market in the country. And this again is up to the government. It's up to the government. Has to have a totally professional debt management function. Someone who can take a view of the market. Someone who can, again, in a stakeholder way, not try and get the government the best out of rate movements, but actually go out and pay the cost of creating a huge block of long-term debt so that a corporate bond market can develop. Then your infrastructure finance and your project finance, you can offer long-term rates. Today, all our TFCs, etc., everything is 6 months floating. It's not. It might be issued for 11 years, but it's repriced every 6 months. So it's not fixed term debt, which is what projects need. And if projects don't get fixed term debt, they put their prices up because they don't know what their long term cost of funds is going. So so then we get a double problem. We get higher costs eventually of projects because of uncertainty on interest rate risk, and your saving institutions, your pension funds and insurance companies don't really have a deep enough, reliable long-term market to invest. Sorry, that's all.
Okay, great.
A couple of points.
Ji, Shahzad sir, boliye. One more. Atif.
One on the technology side, I think I just wanted to emphasize that banks are large users of technology and large investors of technology, but they're not necessarily great innovators of technological solutions. To some extent, yes, but the lethargy that comes from large institutions reflects itself in the ability to innovate very quickly, and therefore partnering with fintechs is absolutely an essential element of future strategies, I think, going forward. And what was just said, I think Salim ne kaha ki there should be funds created within banks to be able to invest in new ideas with fintechs. I think that's absolutely the way to go forward. I think the regulator needs to have a little bit more of an understanding approach, because the current regulations restrict the amount of equity investments that are made, and there are lots of restrictions around that. But I think this is the right approach to take. So rather than making all these fintechs necessarily competitors to your current product set, you actually make them partners, hopefully, and continue to invest in an ecosystem that benefits the customers. So, and in that sense, I think some positive things have been happening recently. So it's not all doom and gloom on that front. I think there's some good things happening, and we can see that the number of transactions on mobile and ATMs and other digital channels is increasing. And COVID has only helped that accelerate that transition. And I think banks realize now that customer need and convenience going forward is going to be driven by technological solutions increasingly. So I think that's an important area, and banks, wherever they can, must support that direction. But as I said, needs a little bit of understanding from regulatory side as well. The other part around corporate finance, one aspect of corporate finance is the value chain financing, perhaps lower level. Value chain financing or supply chain financing is something that really hasn't been structured well in Pakistan and has therefore not taken off. And I think to a large extent, not understanding supply chains and their intricacies and still lending to those the SME chain is a cause for losses and therefore large NPLs. So supply chain financing is something that again requires a lot of investment in systems, in people, in also changing some regulations. I think as far as the short-term element of because you said commodity financing, I think what we need to do is to create instruments that are easy for banks to lend against. And there's commodity financing is just one element, but the whole range of activity around various sectors and various industries down the value chain. If we need to develop the right kind of systems and financing mechanisms. So this again is something that needs to be pushed, and we're talking to the State Bank about this. But maybe another item that you would want to take on as a point of research.
Great, thank you.
Can I come in? Because it can be my concluding remarks also, because I know we are short of time. Few things, a lot of things have been mentioned and they've been going. Let me just say a couple of mythbusters and a couple of things I think we can do more on, and just some actionable items. First of all, I think I totally agree that we have a mispricing here in the banking sector. I think Competition Commission can definitely do another review and all that, but frankly, I've seen a lot of industries in Pakistan. Banking sector, I think, is the competitiveness in terms of, there's no cartel, collusion or anything else. If anything, you can look at and say, what the hell are they doing? I think we're pricing for liquidity rather than credit risk. And that's a very dangerous game. As Zubair said, that we are sitting with a corporate portfolio, which is pretty much at break even if you take the FTP approach, and you're looking at an NPL ratio there, and there's really no ladder up the, if you look at the way we are pricing some of the large corporates, we are pricing them on top of government bonds, which, there's generally a spread. Hopefully that will change over time and sanity will prevail. The second thing about buying PIBs, absolutely, historically PIBs was just an exclusive club of banks, but today with a lot of change in the regulator initiatives, now anybody can go and buy PIBs if they choose to. Yes, there is a form building exercise, and somebody who's been a corporate finance banker by birth, I can tell you that I think I along with several on this call, are big proponents. We should open it up. Debt capital markets should come in. We should use the Pakistan Stock Exchange. And a lot of effort has been done, but we have still not been successful. But anybody and everybody should be able to buy. But clearly, it's not everybody's cup of tea. And the good news is that a lot of money market funds have now gotten into it, which is a good place because we need that. We need that long-term capital. And clearly, the yield curve has to spread out. I think we have been very short-dated for reasons. And clearly, that's the responsibility of the debt management office. We don't have to recreate it, as some of the people said. We already have it. They should play and look at that because we have a debt management office which is supposed to do that. And if it's not doing, we can talk about it. Specialization, absolutely. I think our biggest problem is 35 banks try to do everything, and it's a herd mentality in cases. There's no reason why everybody should be doing agri-financing. A bank that's got no reach in rural Pakistan will most probably will fail. If they have to do it per any directive, I think the best way is to collaborate, work with banks that are in there, which have a network, which have the local intelligence, know the patwaris, know the crop seasons, know everything, because then only will they be able to do effective and remove. Otherwise, they'll be sitting with NPLs. And remember, we are only paying with 10% is our deposit money, is our capital. The rest is we are custodians. Humne kisi ki amanat li hai and we cannot be in this. The same applies when we're talking about putting money into equities or private equity funds or venture capital. Absolutely, we should do it. But there is a cap and we should be very careful how we do it, because God forbid if those fail, we may be in with a big exposure there. But specialization, as Salim Saab was saying, absolutely. I think the DFIs जो हमारी originally money थी या जो हमारी ये और भी money थी ये, you know, Park Qatar, Park Oman, all that, the whole purpose, PIDC जो था, the whole purpose was to provide that long-term capital. And they should not get into the game of doing short-term deposit taking. And, you know, the days, I think they're paying now, right now, but we've seen it globally, and we're putting our money where our mouth is. The idea of opening branches and collecting cheap deposits and lending to government, those days are over. I mean, today with 60 branches, we are the third most profitable bank. So it's again a myth buster that you need a network to do it. You can do it if you do it effectively by cross-selling. Baat ho rahi thi corporate finance ki. Corporate finance, I'll give you a very small example of a crossover between consumer and financial market. When the interest rates were rising, and we saw that, this is before they peaked at 13.25, we went to all our consumer mortgage takers and we offered them a fixed rate 3-year mortgage. बाकी मुल्कों में तो आप सबको पता है 30-year भी mortgage आता है, 15-year भी आता है, 10-year भी आता है. Unfortunately, हमारे पास उतनी depth नहीं थी. अब हम 5 साल का करें. And we offered that. Those customers who locked in today are, you know, in a year and a half or a year into it, and you know, they basically avoided the 13% rise, and they are thanking us. And as the maturities come up, they can reprice it again. Obviously, in this environment, buying a forward lock would not be, because we see a declining yield curve, or at least the slope as well. But these kinds of things, I think a bank should and will do and will be able. And that allowed us to differentiate and become the second biggest mortgage provider in the industry with a very small balance sheet we had. So absolutely, and I think corporate finance हम नहीं कर रहे जिस तरह से हमें करना चाहिए. I think banks have a responsibility, especially in the M&A space. We are nowhere there. If you look at in the debt capital markets, we are doing some good stuff. Different banks are doing it, but again, lots of room where we can do a lot of capital structuring, syndications in the true spirits, not club deals, but syndication, bringing in the fund managers and all that. And I think that would be it. Equity markets mein I think the equity houses like Arif Habib and AKD and others, they've been doing stuff. But again, there's room for us to enter into, and we can probably do it. But again, I would be cautious on picking our spots rather than doing everything, especially the smaller banks. I think the banking sector, while we think it's where it's a tale of two cities, the larger banks have whatever advantages or maybe scale, but the smaller banks are really struggling. And I think the problem is some of them look at the big banks and think that we can do this and we should do this, and they're finding it. Fintechs के साथ absolutely collaboration का payments पे आप मैं ज़रा उस पे एक second बात कर लूँ. We are definitely a payment is a very big part of the banking, but banks also do a lot of other, and we all should collaborate. One, find the future fintech companies that will really be eating our lunch, and collaborate with them and find a way to become co-investors in that, because that could be a smart way. And also learn from their expertise, their nimbleness, their decisiveness, which typically gets lost out in large organizations, given the bureaucracy and everything else. And again, what's the return in 3 months and 6 month mentality. So I think there's an opportunity to do it. And jo Atif baat kar rahe the, you know, supply chain. I think there is a lot to be done there, and we along with others are doing it. Same on this, sticking to the same topic. Aapne baat kari ki with technology and how we are. Look, I mean, it's no secret. I'll give you some numbers. 130 million people are bankable above the 130 million above the age of 18. 53 million bank accounts. And if you look at it, branchless banking accounts are 47 and over 100 million unbanked hai. Iske agar aap apna mobile le lein, 165 million mobile subscribers and 77 million have access to mobile data. So clearly it's a subset of our target market. So we need to find a way of how we can work with them, how we can really use that to become, if we don't do it, they'll come into the space, and they are itching to do it, and rightfully so. So I think that one has to look at it, and the market of, so digitization is the need of the hour. And I think COVID ने एक और amplify कर दिया digitization का. I think हमारी ATM growth अगर आप देखें CAGR of 17% of last 5 years, but from a very small base. Distribution points, they came 420,000 distribution points. Again, the numbers are relatively small given our population. But I think there is definitely a lot to be done on the digital space, and that's what will make the cost of delivery. Abhi jo problem hai na, there's a lot of investment required, and the cost of delivery, cost to serve has to come down to make the digital a reality. And I think that will happen as people do it in that space. And finally, on a lighter note, I want to thank you once again, only because I realized that I'm the only non-city banker on this August panel. So recognizing that there's something beyond Citibank is a big honor to me. Thanks.
But that's Standard Chartered, so it's a cousin. So no problem there. It's a cousin of Citibank. But anyway, let me take a quick round of questions, folks, before you so indulge me for a little while. We'll take a quick round of questions. Please be very brief. Identify yourself and be very brief. I'll collect the questions and come back to the panel. Asif, Saeed.
Hello.
Ji. Boliye.
Hear me?
Ji, we can hear you.
So first of all, I want to congratulate you. This is a wonderful panel that you got together. I would go on to say that this is an encyclopedia of banking. In terms of background, my name is Asim Saidji. I'm member Planning Commission, Private Sector Development. And I am an ex-city banker. I apologize to Dada Saab, another city banker. And I have my mentor on the panel, Zubair Sumro Saab. Sir, always good to see you and hear your lovely voice and words of wisdom. And I have worked in Pakistan in the commercial space, corporate space. I was in Qatar as well, corporate investment banking. And then I moved on to Asia. I worked in Hong Kong, and then in Singapore. I used to cover ASEAN region from a capital markets perspective. I also used to cover India. Nadeem Saab, I want to share it's not more of a question, but just a very short 1 minute of my, experience that I want to share with everyone and the panel. The only advantage that I have over the panel is probably my age. I'm much younger to them, that's where I can probably add a bit more value. And I want to go back to the initial question, why, the young bankers are there. The point of NAB was mentioned. Yes, probably I can, I know that more than anyone working for the government right now, and what this menace is, hovering over us. We deal with that every day. But that was not always the case. Probably this is more so nowadays. I think the economic environment of Pakistan played a major role in the last 10 to 15 years, where, the likes of myself and many of my colleagues just wanted to go out, when the terrorism was quite prevalent in Pakistan and things weren't great. Culture was also a major factor, I feel. We used to dig Western culture. I've seen that with myself, and I've seen that with a number of my colleagues who continue to work in international organizations. And we must not forget the fact that bankers generally inherently are highly motivated. So they're always trying to climb the ladder and go on to greener pastures. And when I was abroad working in Asia and Hong Kong, there were three key things which a banker would look at. One was that, he or she always wanted to go for a larger region, money, and learning. And when you're coming back to Pakistan, two of those three factors, they're absent. The larger region is not there. That gets substituted with visibility in a country like Pakistan, and it's a nascent market. So learning is also not as much as you would get abroad. So the factors which would pull you back are probably family, visibility, money, and authority and delegation, which was talked about. One another brief point is, since I'm a capital markets guy, I've not followed Pakistani markets, but I think the role of bankers is very important. When I used to cover Indonesia, I used to cover government of Indonesia. I've done government of Malaysia, and I've done all their SOEs and their high yields as well. It was our responsibility, along with our partners, legal partners, to educate our clients on the products which are out there. They may be vanilla products, whether it was on the structuring side, or the features of the product, or even on the disclosure side. And I felt that that's how the market developed. And I saw that myself, and I was a part of it when we we did transactions for the government of Indonesia and for their SOEs. So I just feel that perhaps that angle may not be that prevalent in Pakistan. And when I just went through the recent Sukuk transaction for the government of Pakistan, I'm sorry to say, there were a lot of things which were not right about the trade. And I've written a note internally to finance and also to the minister on that. Some of those aspects have been mentioned, which are on a book, book building. It was a surprise to me that that was done for the first time. It's a very simple thing which is done globally. I think Salim Raza Sahab talked about Kaibor repricing. Yes, yield curve is absent. Kaibor is, if you do a Kaibor link deal, it gets repriced on the reset date. So you really don't get a yield curve. Market strategy was, I couldn't really understand what the market strategy was. And, the liability management also wasn't there. So I just feel that when I looked at this product and this transaction, although the pricing was great, Kaibor -10 versus the previous one, but I just felt that there was lack of understanding of the product generally. And I feel that that goes back to the heart of our training and the kind of people and human capital that we induct in our banking. And I'll just stop there. Thank you.
Thank you. Ajwad Saab, Ajwad Imran.
Gee, thank you. My name is Ajwad. I have experience in investment banking and private equity in both London and the US. And I have three questions. My first question relates to non-performing loans. One of the consequences of this COVID crisis, as we all know, is that NPLs are going to rise tremendously over the next couple of years. And what we've seen, at least in India, is that there have been opportunities for foreign buyers of distressed debt to step into the market. And what this does, as you all know, is that it helps banks clean up their balance sheets and streamline their capital towards more productive activities. So first question is, what scope do we see for foreign buyers to step into the NPL market in Pakistan, and what support do we need from the regulators? My second question is on the collaboration with technology firms. Atif Bajwa and Shahzad Dada and a couple of others spoke in detail about the collaboration going on with Fintech. But as you all know, cybersecurity is one of the big risks facing banks globally, and we've seen a rise in cyber attacks happening. So can you talk a little bit about what your banks are doing on that front to protect the deposits of the millions of people? And my third question is on the development of the debt capital markets. As you all know, in the late 80s in the US, Michael Milken spearheaded the debt capital markets for high yield companies, which helped them raise debt at much higher rates, but at least gave them the optionality to access capital. So what scope do you see for companies within Pakistan accessing those kinds of capital, but at higher returns? Thank you.
Thank you. Shoaib Jamali.
Yes, thank you so much. I just have two quick questions. The first one relates to financial inclusion, and I'm interested in finding out the degree to which Islamic banks, branchless banking, microfinance banks and institutions have helped grow financial inclusion. In the sense, do we have data that shows growth in unique number of depositors and borrowers across all these platforms? Because if you look at anecdotal evidence, that suggests that people have actually multiple accounts across all of these platforms, which sort of inflates the estimates of financial inclusion in Pakistan, which, as you already know, is rather low compared to the region. So, the question is really, do we have unique data that can shed light on the state of financial inclusion in Pakistan? The second question is, and this is really, I'm just echoing the questions the discussion that I had with one financial market expert a couple of years ago. And his take was that where will the demand for long-term debt papers will come from? Because he argued that, well, life insurance walas are not talking in the interest of the saver, because they offer a fixed amount, say whatever, 10, 20 million after 20 years to the saver, regardless of what maybe the inflation during that period. Whereas a pension sector across the world was sort of shifting from defined benefit to defined contribution, which also sort of does not create a demand for long-term papers, because people would rather invest in instruments whose coupon rates sort of change every 6 months or so. So most corporate sector has already started switching to defined contribution, we argued. And so therefore, over a longer term period, the demand for long-term papers needed to finance sort of a mortgage and meet those long-term asset liability mismatch. Where would that come from? Those are the two questions that I have, and anybody from the panelists could answer. Thank you.
Naseem Beg, sir.
I'd like to just go forward on Shoaib Jamali's point on the demand side of, let's say, for infrastructure finance, forget mortgage finance for the time being, fixed rate paper. The last seminar or webinar you held, we had a person in from the life insurance sector, and he was very clear that they had no demand for asset liability matching because they were only offering unit-linked policies. While the State Life, he felt, might have. I'd also checked with State Life, and they really try and pick peak rates, and they don't do asset liability matching. So the question is, has any research been done, and I'd put it to Salim Raza, on the actual potential, some data on the funds that could potentially get into asset liability matching. Whether or not people do it right now is another matter, but whether in life insurance or in pension, funded pensions, which are very few in any case.
Malihat Bangash.
Assalamu alaikum. Thank you, Nadeem Saab. First of all, thank you very much to the entire panel. It was really an enlightening and enriching discussion. I feel very fortunate to have heard all of you. A bit of my background: I have served in Singapore on the private equity and investment management side. I have been a member of the Competition Commission of Pakistan, and have in my most recent role been looking after more access to finance, wearing a hat of the investment climate and World Bank initiatives that were ease of doing business and investment climate. With my access to finance was a very critical aspect, and I have been for the past 2 to 3 years involved with micro and SMEs, and which brings to me to a question that I wanted to raise to our very distinguished and august panel. First of all, thank you to Mr. Atif Bajwa and Mr. Shehzad Dada, to whom I'm initially asking this question, is that because they raised how very good insights on how SMEs and microcredit should now be focused upon more. I'm going to just, since most of what I had to ask is addressed, I'm just going to ask their view on how perhaps digital banking and technology-driven solutions, and Nadeem Saab, you also spoke of innovation, perhaps that could be one of the leverages, so sort of the levers or the leveraging factor where we can actually sort of catapult ourselves into a more inclusive, financially inclusive aspect. So I would love to hear from them. The other question, which is actually to the entire panel, specifically to Mr. Salim Raza and Mr. Zubair Sumro, because I would want to know from their perspective, since they've had very rich experiences, and of course to everyone else, is that COVID-19 has had an impact on all of us, all businesses, which means that from banking perspective, it's especially important because our clients are now going to be affected, and of course our own businesses, as in the financial sector, is going to be affected. So is there any one learning or any one thought or perspective that you'd like to share that going forward might have changed, or you might be looking differently at after the lockdown eases or things open up?
Great. Thank you, Maliha. Idris Khwaja, quickly. Come on.
So my question is to the panel is that what are the hurdles in having a secondary market for the government papers like PIBs and etc.? Because we said that banks are investing only into PIBs. So if there is a wider market, then probably there would be less scope for the banks to invest. Secondly, there was a question about the issue of competition. I think Pakistan is sort of signatory to the Basel Accord, which says that the minimum capital requirement for opening a bank is $100 million. So that's a lot of money in Pakistani context. So can something be done in this regard?
Nizam Saab, last question. Nizamuddin Arshad. Nizam Saab, are you speaking?
Yes. Sorry. Assalamu alaikum. Thank you very much, Nadeem sir, for putting together this excellent panel. My name is Nizam. I worked with State Bank in Pakistan for almost a decade, and currently serving as an advisor to Governor in Central Bank of Kuwait. My question is, and actually I was kind of surprised that as we are talking about banking sector, we barely talked about the stability of it. There was a lot of discussion about inclusion. There was no discussion on integrity of the financial system as well as on the stability. I'll leave the integrity part for a later discussion, but let me come to stability part. And probably it shouldn't be puzzling because as many of the speakers have pointed out, essentially what our banks are doing are lending to the government. So if you are primarily lending to a risk-free borrower, there should not be much of a concern on stability side. But that also means that probably, and as some of the speakers have pointed out, it means that we probably would be underestimating the risk to stability. At the current time with the COVID, we know that because of extraordinary relief measures as well as the payment moratoriums, we will not see the immediate impact on NPLR, for instance, because it will take time to crystallize. But as the time passes, probably by the end of the year, we'll see these numbers in banks' infected portfolios. So I'd like to hear about the panelists' response in terms of how they see the stability going forward. Secondly, we also didn't touch base on, we talked about digitalization, but a key threat, in my humble opinion, that banks would face going forward in terms of digitalization is whether the central banks decide to issue digital currencies. And more critically, if they decide to allow the public to directly have accounts with the central bank or through the financial intermediaries. Because if the central banks decide to allow the public to have a direct account, after all, if it's a digital system, why to have a financial intermediary in between? And that would probably significantly reduce the whole position of a commercial bank as an intermediary. And finally, we talked about education. Just a quick observation, because while I was with the State Bank, there was a great emphasis on improving education within the central bank itself. And I also took the exam of IBP, was the high score in the country. But then I realized that as I went to LSE in Columbia, that the IBP exam was not as easy as even compared to these top schools. But there was no reward at all. For example, when I later did FRM, I think FRM was globally recognized, but was less demanding. On the other hand, the IBP exam that I passed in 2003 was almost equivalent to a master's degree, but was absolutely not rewarding. There was no recognition at all. So because I wanted to raise this point because some of the major bank executives are here, and probably they should look at, I don't know, something might have changed in the last 10 or 15 years on the IBP's curriculum or its recognition. But if we don't have the institutions who could be globally recognized, I think there's no point wasting individuals' time pursuing an education that even our own community would not be willing to acknowledge. And probably they should collaborate with CFA or FRM, GAP, Global Association of Risk Professionals, the GAP, USA-based GAP institution to offer those educational incentives which are at least globally recognized. Thank you very much.
Thank you, Ji. अच्छा जी, let me turn to the panel now. मैं साथ एक question अपना भी add कर दूं अगर हो सके. We haven't spoken about regulation and taxes. So to all the panelists, as I go back to you, please address what are the key changes in regulation and taxes that you need? Because quite frankly, I think one of the biggest problems in this country is that we are regulated beyond the moon and that our tax structure sucks. So please go ahead and comment on the questions. Salim, can you start?
Now, I leave the issue of taxes with one of the current bankers. But let me just talk about COVID, because I think 3 people raised it, including Ms. Bangash, 2 other people did. In other words, how ought we to prepare for the damage that will happen to companies and therefore potentially to banks' balance sheets, were COVID to deteriorate from where we are? I'm not saying that we've got, a huge blow coming now, but if this continues for some months, perhaps there will be. If you look at what other countries are doing, you look at the EU, the UK, the US, their governments are putting money into companies via the conduit of banks. So banks are now going to be responsible for monitoring and collecting that money, and they'll earn a spread for that. In some cases, some residual risk is being left with banks. But the important point is that the money going in is a layer between bank debt and equity. So in our case, there will be some companies that will collapse. There'll be some companies where the equity will have been worn very thin, and the bank may not want to continue lending to them and may look for foreclosure. And there'll be some companies that will be all right. It's the middle layer that I'm talking about. Where is that equity going to, where is that sliver of subordinated debt or subordinated debt going to come from? Because the banks aren't going to put it in, and this isn't an environment where our corporate sector is going to be too enthusiastic about that sort of exposure. So that's what in the West, that's the role the governments assume. Now, we so far are relying on liquidity to do the trick. We're refinancing, we're providing refinancing at concessional rates. Those are all very good things. And perhaps in today's environment, that is enough. And, we might be all right in a couple of months' time. If it deteriorates, you're going to move from liquidity to solvency very quickly. And that's really what I'm talking about. Where is this pool of funds? Who are going to be people who will come and perform that role of subordinated debt or even equity? So I would suggest that the government think about creating a fund, and they can get some money from the multilaterals, some money from the international development banks, some money maybe from our banks and from many other investors. Let the banks apply for usage of that pool in particular cases. This fund or the members of the fund decide what they want to support, what they think is worth supporting, what is not worth supporting, and they can have a criteria, for picking and choosing. And this will then keep a lot of businesses going that might otherwise have been wound up. What I mean by this is the total bank exposure outside government securities today is 8 trillion rupees. If there is a 5% hit to this 8 trillion, that's 400 billion rupees. The total capital of banks in Pakistan is about 1.6, 1.7 trillion. So a hit as big as that, 400 billion rupees, is sort of 25% of existing bank capital. It won't happen. I'm not even suggesting. But I'm saying that if we, earnings in a year like this with slow growth anyway are going to reduce. Otherwise, earnings would normally take care of a shock like this. But our earnings in 2018, bank earnings were about 300 billion rupees. And I'm talking about a shock of potentially, worst case, 400 billion rupees. So you see the need here for this intermediate form of equity that companies are going to need. And that has to be thought about. Liquidity won't do it. If you're looking at liquidity, remember Japan's zombie companies and zombie banks. The Bank of Japan opened up its coffers, refinanced, its balance sheet went from 10% of GDP to 105%, keeping alive all these companies in Japan that had got decimated by the asset price shock in Japan in the early 90s. So you provided the liquidity, you kept the companies afloat on liquidity. Banks were given remission on recognizing bad debt. In other words, they were given forbearance. They didn't have to recognize. The standards were changed. And they continued lending to companies that were going nowhere. So liquidity doesn't really do the trick. You've also seen this in EU, in what the EU and what the Fed have been doing in providing liquidity to get growth going, and it's not happening. So to get back to the COVID impact, I don't think we're looking at a serious crisis now for the moment, but I think in 2-3 months we could be, and I think we have to prepare to find an equity counterpart to liquidity that will bolster the continuity of many companies that might otherwise go under. And if they went under, then the damage would be on banks' balance sheets. So the government, and obviously the government would need to support banks. The question is, do you put in money there or do you put in money now? And this is just a thought that sort of came to me while you were talking about when I was asked about how we would tackle COVID. Anyway, that's Mr. Naseem Beg's question is very interesting, but frankly, I'll have to think about how to answer it, so I'll leave that for the moment.
Okay, great. Zubair, do you want to take up any questions or last-minute comments? Zubair?
Sorry, I was on mute. Mute. Yeah.
No
on this COVID impact issue, I think where unfortunately it is going to fall very hard is on this microfinance sector. The microfinance, because of the number of daily wage earners that they finance, and then the small businesses they finance, these are being hit very hard. And the default rates now coming out of that sector, are alarming. So they will need both capital and funding support for the next 12 to 18 months to ride out this whole period. Otherwise, you have this group that now finances 7.5 million borrowers. And, with our household size of about 6, that's more than 40 million people that are dependent on this sector. I think that needs urgent attention.
Okay. Atif?
I'll just take up a few questions that I just jotted down in no order of priority. The first one I think was about cyber crimes and how do we protect our customers against cybercrime as we invest in digital solutions. So I think without going into technical details, I think this is absolutely a number one concern for us because it's so important for our customers to feel secure. And so, we're investing a lot to make sure that whatever solutions we come up with are properly protected with the latest technology. And that keeps changing, of course, as you know, because the perpetrators of crime keep moving the goalpost. So that's an important area that will continue. I think the other question, I think around COVID, which has already been taken up by Salim and Zubair, I'd just like to say that while it's extremely critical that we support our customers right now, and the main way in which we're supporting them, as has been mentioned, is providing them liquidity to overcome this period of time, hopefully, in which they're also trying to reassess their business models and see how they're going to survive. That liquidity is being supported by the State Bank also through their refinance schemes. However, it's still debt. So you're actually putting more debt and therefore risk on the balance sheets of the customers. And hopefully they'll come out of it, but there is a percentage that will not come out of it. So that's an increased risk that is being put on the balance sheets of customers. And the central bank is asking us to to do more and more of that kind of support, which we are doing to the best of our abilities. But the other thing is it increases the risk on the bank's balance sheet significantly also. So a number of these new loans to provide liquidity to our customers may end up in increased non-performing loans and therefore provisions. So capital cushions will come under pressure. And I think that is something that we all have to be aware of. And therefore, the need to look for alternative structures, as Salim mentioned. We need to have structures outside of debt to support our customers as well, which for the bank will still mean more capital allocation and more risk, but perhaps that will be a more sustainable way of supporting customers. So that was the one question that I think Malia asked was on SME and microcredit. How do we use digital banking for further inclusion? I think clearly the way forward is to further strengthen digital banking platforms for individuals and corporates and SMEs. And so a significant amount of investment is going in. I think we're still touching the surface, the tip of the iceberg. I think because of what has happened in the last 4 months, you'll see some acceleration in investment in that area. So more SMEs should be serviced through technology solutions. And part of my earlier discussion about supply chain financing has to do with this kind of investment. I think a question by Nizam Sahab was, around stability, underestimating the risk of COVID. I think that's been just answered. And education, recognition of certification of IPB, I think that's an important point that, as we develop our human resources and our skill sets, that we upgrade the training and the certification that we have available, and also use that as a means to progress the careers of our people. And so we're actively looking at making sure that career paths are clearly defined along with increased certification that people go for. So those are the key things that I thought I'd mention. I may have missed
regulation and taxes. Can you go into that a little?
Taxes
are the key changes in regulation and taxes. Do you like being a tax collector for the government?
Oh, absolutely. I mean, no, but I think that's something that we react to more than. But taxes for banks itself, I mean, I think that's an issue that we can discuss, because banks have been used as the milking cow as far as taxes are concerned. So every now and then, when taxes have to go up on one pretext or the other, banks are the ones that get the big bulk of it, because they're documented, they're in the organized sector, they can pay the taxes, so they get taxed most heavily. And these kind of taxes, without having any long-term view on a strategy, actually creates further distortion. So we've been talking about pricing and risk distortions on one side. Taxes, or the lack of long-term understanding of what these taxes are going to be, creates another kind of distortion. And that's clearly not what we want to have done to us. And also then to be collectors on behalf of FBR with our customers, clearly not a desired scenario, but we have to abide by whatever regulations come our way.
Sure. Okay. Ji, Shahzad Sahab, bataiye, is it easy for you to create new instruments to innovate? Does regulation stop you, apart from other questions? And on taxes, I mean, is that what's driving deposits out of the bank?
No. Okay. So as far as new products and new services, and I'm saying this not to for any, and I really mean it, that I think we have a regulator who's quite open for new ideas. We get challenged, but there's never been a stoppage that we can't do it because the answer will be no. And being on the regional management committee covering almost 25 countries and worked in different marketplaces, I think we have a much better liaison between the regulator and regulatee. So I think the product stoppages are not there. I think the infrastructure in some cases, I think the lack of documentation and all those other things come in play. But in terms of regulations, I think even if they're not there, there is a window where one could really present to the regulator and have an open and transparent discussion. You will not always get what you want, but again, there's good debate and risk-based debate that happens. So I would not want to hide behind the regulations or not coming up with new products. I think, that's not the thing. I'll come to taxes in a minute. I think just echoing some of the things that was said. COVID पे clearly, I think every bank is monitoring that. Uska impact क्या होगा? Especially, we all back-ending the deferrals by a year. So year 2 में क्या होने वाला है? If things don't pick up, or if the turnaround or the recovery is not more of a U shape or W shape or whatever shape it takes, I hope it's not L shape recovery, then I think we would be in a problem, because a company which was supposed to sort of amortize its debt over 2 years is now going to amortize all in year 2. And will they have the financial space to do it? And I think as banks, we'll need to be very cognizant of that, because that also gets into the whole question of stability debate that we had. But I won't spend too much time on that, but that's something we all are monitoring very closely. Cybersecurity, no questions about it. I think that is one of the biggest risks we have as we transform from analog to digital to systems, payment systems, or manual to digital, or digital to and you start using a lot of different vendors that are coming into our mainframes, our main systems, and I think protection there has to be there. And I can just speak on Standard Chartered. This is one of our main risk types now, cybersecurity, and a lot of investments is happening. And frankly, what worries me is the kind of investment numbers we're hearing. Can small banks really do those levels of investments? And if they don't do it and sort of put these systems in place, it can come to bite. And we have seen some small examples of that. And I think making sure that we have a very robust infrastructure, and because we all banks deal with each other, I think there has to be a lot of emphasis on that. I think one other question was on distressed debt. Absolutely. In distressed debt, collateralized mortgages, all of these things are great ideas and they should be in place because we can package them. But distressed debt pay, I think clearly, I think there is room to do it. There's work being done at the regulator front also in bringing this more in the forefront. So there is a secondary market. And like I said early on, I think bringing debt capital markets is you're going to do price discovery and a secondary market, which will give a lot of opportunity to do origination work, because if you can sort of do it, because the banks also have limited capital and limited risk appetite, so that can be done. Taxes pay, look, I'm also going to share something from an OICCI platform. I'm the president of OICCI and we put a tax proposal. We're working very closely with the government and all the stakeholders in ease of doing business. One of the key impediments is taxes. I think today a business operating in Pakistan, typical business, and I'm not exaggerating, 60 sales tax returns have to be filed annually and deal with 5 different authorities where the rules are different, either regional or provisional versus federal, and it's really a complex structure that really makes it very difficult for new businesses to come in the forefront. And again, on one hand, we are seeing documentation, and on the other hand, we have a very complex and inefficient retrogressive tax. So we need to encourage that, simplify it, and again, as key stakeholders, we have to do it. You asked us the question, do we want to be tax collectors for the government? Look, if that's, I think the simple answer is ideally not, but if that's something we have to do to the betterment of the economy and the country, we will do it. I think, and we are doing it, and it's happening. Though we, where one area where I think we have some sort of had challenged it back is where other parts of the economy or other parts of the agencies are not doing their part. For example, customs is, as we know, there are a lot of leakages there and a lot of things. So there's a new regulation that's come around trade AML. जिसके अंदर banks not only have to process the transaction, do financial crime risk, money laundering, all or AML, CFT, which is our job and we'll do it. We also now have the duty to, or the requirement to check on the prices and make sure the under invoicing, over invoicing jo ho rahi hai, wo nahi ho rahi. Again, I think the problem is people are not trained for that. They're not experts on knowing what, plastic 701 that's being imported by a textile dyeing company, what the pricing on that will be. And I think that puts a lot of onus on us, because if that happens, and that's something we are working with Fintechs, for example, in trying to come up with modules and using of artificial intelligence and all that, because that can be a big danger to banks, especially banks who don't have the resources to invest in doing that. And I think it's because we have a strong regulator and a strong regulatory body, people have looked, FBR and others have looked to us to really play that role. But actually in a well-oiled economy and a well-oiled country, that should be the responsibility of customs department, that they should be doing that. But because they have failed, we have been put that challenge. And I think that's going to distract us and take away what we are good at and continue to do that. So I think Udar, there's clearly a thing. And lastly, on tax rate, we are the punching bag, as Atif said, though he did not use the word punching bag. Jab bhi taxes ka hota hai, we become the thing. We are the only sector that has got super tax. This is something we have raised again. We don't mind paying taxes. We don't mind doing what we are supposed to do, but we also are big believers that we need to widen the tax net. We cannot tax the already taxed for just being good corporate citizens, and we'll continue to play our role as required. I hope I've answered some of the questions that one answered. Thank you.
Alman, you can sort of sum up the debate.
I think everything's already been said. There's not much to add there. I go back to my original point that as long as the banks have a certain portion of their income comes from easy PIB sources, there's not going to be a motivation to do all the things that people are talking about. And two other things need to also change from a regulatory environment to assist the development of various things in banking. One, as my own bugbear, is the FBR, because that distorts the way businesses think, especially since we're talking about not the large corporates, but we're talking about the SMEs and the small businessmen. The fear of FBR is so great that most of the stuff, the things that we would like to do, which would make them bankable and come into the formal sector, they're afraid of doing that. They have no problem in paying reasonable taxes. They have no problem keeping their books. But the fear of FBR coming in and doing whatever they do is a concern. And I think the third thing is the legal system. We just don't have a legal system which encourages lending and getting things done. I will defer to what Atif and Shahzad say about the regulator, but my own experience with the regulator is that trying to get things done is very, very difficult. I can give you several examples of where we have tried to develop secondary capital markets, tried to develop hedging markets, and we put a lot of effort into that. And I'm talking about when I used to work for Citibank. But, and I can understand it's not the regulator's job to take those risks, especially with NAB in the background. And they have to allow the markets to perform. And yes, they have to give regulatory oversight, but they can't be held responsible if something goes wrong, not from a regulatory aspect, but from a market aspect. And that view, unfortunately, is not held by the authorities of the government. So those are the things that have to change to make things happen. And that's all I have to say.
Thank you very much. Thank you to the panel.
Just one last point, if I may. I think one of the key aspects of the recent kind of developments for the banking sector that we've not touched upon is this increased requirement for compliance across the world, FATF and whatever else. And I think that's been putting pressure on the banking sector in the sense that it needs to adapt and adjust itself to a new reality. Part of that reality means that because of the questions that are being asked of customers and source of income and wealth, means that funds have been flowing out of the banking system. As Salim also initially mentioned, about 43% has moved, is now, of money supply is now in cash. And I think from years ago, I also remember Salim saying that the multiplier effect of a bank deposit is about 3.4. So 1 rupee coming into the banking sector actually multiplies economic activity 3.4 times. And conversely, 1 rupee going out has a similar disadvantage for the economy. So this is an issue that needs to be addressed at some level because the ability of the banking sector to do much more with the funds that are now lying under pillows and mattresses would be significant. So I think that's just leave it to you to maybe research on this and discuss with the government the cost of this money going out for whatever reason, whether it's for tax and documentation reason or for compliance and all that. That has a cost to the economy, and that cost can be calculated. Had this created that 3.4 time multiple, it would have caused increased economic activity, it would have caused increased taxes, etc., etc. So what is the net cost of this recent change that we have seen in the economy?
Fair point. But on this, let me also say that I think, quite frankly, some of this is self-imposed. It's really not FATF at work. For example, let me give you a very simple example. PIDE was going to get some money from the UNDP, and the UNDP wanted us to open a new account. Now, PIDE is a government-owned organization, has absolutely no suspicion or anything about it. We went to 3 banks, and 3 banks refused to open our accounts. Finally, I had to call somebody like you on a personal basis, and the account was opened. Now, this is a government agency. UNDP is paying the money, and there was no reason not to open the account. Now, when I go to the US, for example, even today in the US or UK, opening an account is very easy. It's not difficult. They don't ask you 10,000 questions. They just open your account because they link your account up with your whatever documentation there is. Here, unfortunately, you have to give your ID card. I don't understand why you have to give the copy of your. What do you do with the copy of your ID card? You have to sign 10,000 documents. I don't know where you put them. There's a storage cost too. So I think this is the regulator's problem. This is not FATF at all. You agree with me or not?
No, I agree. Maybe the pendulum has shifted from one end to the other a little bit too much. It needs to come back to a more reasonable level. Bankers have to get a little bit more used to this and understand the requirements better. Also, as far as new documentations, we've got to move to digital processes, and so all this extra paper has to be converted into digitized data. Otherwise, we just can't handle it. It's just getting too big.
Because in the US, once you give your social security number, after that, everything is seamless. Once they've identified your social security number and they've rigged it up with all kinds of other accounts, all that is done electronically while you are just filling in your social security number. After that, everything is seamless because everything is connected with that. Here, unfortunately, you have to reprove again that I exist, I'm a human being, I'm this, I have an address. All that crap is not necessary once I've got an ID card, right? Anyway, folks. Sorry, go ahead.
I think so we're moving in that direction in some ways with this new digital investment that's taking place.
Thank you, Salim. Thank you, Zubair. Thank you, Atif. Thank you, Shahzad. Thank you, Alman. Thank you, everybody. It's been a wonderful discussion. I really enjoyed it. I have nothing more to say except to say that we have once again see the slide stands. The government policy is very distortive. Tax system is distortive. I wish you could change the government. I wish we could have reform, but unfortunately, there's no appetite for reform in this country. So we'll keep plugging away. We hope that lots of research will come out of this, and we'll be back in touch with you as it happens. Thank you, folks. All the best.
Thank you. Thank
Gratitude.
you.
Say goodbye to you.
Thank you.
Thank
you. Thank you.